When Silicon Valley Bank began to unravel, one DeFi protocol noticed something strange. Collateral liquidations started before the market even moved. The cause came down to a single number, 0.88. That was the sudden trading price of USDC, the stablecoin considered the most bank-backed and the most secure. And the world saw USDC's stability doesn't come from blockchain, but from decisions made inside specific banks. And banking failures in the United States happen far more often than people think. Today, $27 billion are tied to that fragility. The face of USDC is Jeremy Allaire, calm, structured, confident. He spoke the language regulators loved: order, reporting, transparency. Circle built the image of a stablecoin that behaved like a financial instrument rather than a chaotic crypto asset. That image became the foundation of public trust. For millions, USDC looked like a digital dollar you could hold without fear. But its strength was tied to a system that regularly breaks. USDC grew quickly and cleanly. Funds, exchanges, and DeFi projects integrated it as a reliable base for liquidity. Circle emphasized full backing and storage inside US-regulated banks. The formula felt flawless. Want stability? We have it documented. USDC became a symbol of order in the chaos of the crypto markets, but its model depended entirely on the stability of banks. When Silicon Valley Bank faced a run, part of Circle's reserves fell into that vortex. Not lost, just frozen until regulators decided what to do. That alone made USDC's price shake. The dependency became clear. If a key bank takes a hit, USDC cannot hold $1. For a digital currency, this is not a bug. It is the core risk. The SVB crisis did not last long, but it revealed the truth. The stablecoin meant to ignore banking shocks reacted to them faster than the banks themselves. Traders rushed to exit, protocols liquidated positions, and large players waited for a government response. And only the government rescue restored USDC to $1. Not crypto mechanics, not reserves. A decision that could have gone either way. That moment became a cold reality check for those who believed USDC was unbreakable. After the crisis, analysts dissected Circle's reports line by line. Yes, most reserves were U.S. treasuries, but a meaningful share sat in commercial banks with no protection from sudden failure. USDC turned out to be a digital version of the banking model, stable in calm conditions, fragile in systemic stress. But with one difference, USDC holders have no deposit insurance and no influence if a partner bank collapses. That makes the structure more fragile than it appears from the outside. Imagine a new wave of banking stress. One of Circle's partner banks reports liquidity issues or faces an investigation. The market does not wait for the outcome. USDC starts to wobble instantly. 0.99, 0.96, 0.90. Liquidations in DeFi, funds closing positions, traders running to cash. Algorithms accelerate the movement, turning hesitation into a cascade. And once again, a stablecoin designed as protection from chaos becomes a reflection of someone else's crisis, only in a faster form. The story of USDC is not about a mistake. It is about the illusion of control. Circle operates transparently, publishes reports, and works closely with regulators. But as long as part of its reserves sit inside traditional banks, future risks will be defined by decisions made behind closed doors. And if even one partner bank loses stability again, the shock will hit USDC from within. $27 billion are already tied to this system, and the real question is not whether USDC trades at $1 today. It is what happens the moment the next bank shows weakness. Those who understand this act before the fall, not after. Subscribe to stay ahead of the crowd.